Wondering what kind of home you can afford with a $50,000 salary? Well, let's take a deep dive into your options with the current interest rates. Whether rates are at the usual 6.5% or they fluctuate to 5% or even 8%, we've got insights that you need. Today, we're going to explore various payment scenarios, specifically focusing on FHA loans under different interest rate conditions. We'll start by looking at today's interest rates, which stand at around 6.75%, but we won't stop there. We'll also consider the possibilities if rates were to drop to 5% or go up to 7%. The FHA loan, known for its leniency with debt to income ratios, down payments, and credit scores, will be our focus. The FHA loan program is unique because it allows for a purchase with as low as a 500 credit score. However, if your score is between 500 to 579, you'll need a minimum of 10% down. Scores above 579 qualify for a much lower down payment, which is just 3.5%. Let me give you an example. Buying a $100,000 home requires a down payment of just $3,500. If the home costs $200,000, the down payment would be $7,000. This pattern continues upwards, adjusting with the home's price. FHA loans are also advantageous because they permit a higher debt to income ratio of up to 57%. This is significantly more accommodating than conventional loans, potentially enabling you to afford a more expensive home. Now, this feature, combined with lower credit score requirements and down payments, make FHA loans an attractive option for many buyers. This is what people call the first-time homebuyer program, or what they think of when they're saying the first-time homebuyer program. It's important to note that meeting the basic FHA criteria does not automatically ensure loan approval. Other factors such as your work history also get taken into consideration. It is crucial to remember that this video is meant for informational purposes and should not be taken as a guarantee of a loan qualification. For accurate and personalized advice, consulting a mortgage professional is always the best course of action. I'm just here to provide value and knowledge and educate those that are watching. If you're in need for a recommendation for a reliable mortgage expert, please feel free to use me as a referral. Reach out to me. I'd be more than happy to assist. Now, let's circle back to our initial question. How much can you afford with a $50,000 income with current interest rates at 6.75? Before I go into this, many potential home buyers are currently waiting for rates to drop, but this strategy might backfire if rates actually increase, leading to less affordable housing options. Now, the goal of this discussion is not to push you into a home purchase, but rather to provide a comprehensive understanding of how interest rates affect the housing affordability. Now, there's a widespread belief that waiting out the market will lead to lower home prices. However, if interest rates significantly increase, we might witness the opposite trend. Now, we know that this year we are supposed to see some interest rate decrease, which is huge news for us, which obviously this could provide a bit of a spark in buyer demand and stabilize or even increase home prices. Now, this means that if rates do drop, while your monthly payments might improve, the overall affordability might decrease due to higher home prices. The crucial factor here is to make a well-informed decision considering your personal circumstances and not just market predictions. Now, if you're looking to buy a house that costs $250,000 with current interest rates of 6.75, you are looking at a down payment of $8,750. This down payment results in a base loan amount of $241,250. One key aspect of the FHA loan to remember is the upfront mortgage insurance premium. This premium slightly increases your loan amount, but it's a trade-off for the benefits of a lower down payment. With current interest rates, your monthly mortgage payment would be around $1,583. When you include the average property taxes and insurance, the total monthly payment would be around $1,997. This payment is manageable on a $50,000 income, provided you do not have any significant other debts. However, if your interest rate goes up to 8%, your monthly payment could increase to $2,200. This increase could potentially push you towards looking for a less expensive home. On the other hand, if rates were to drop to 5%, your payment could decrease, making a home worth $300,000 more affordable and attainable for you. Now, these examples highlight the importance of understanding how interest rate fluctuations can impact your buying power. And I want to leave you with this. It's worth noting that your credit score and down payment size can influence your interest rate. This is particularly true with FHA loans, where rates and mortgage insurance costs are relatively stable for scores above a 680 credit score. But remember, with FHA loans, if you make a down payment of 10% or less, mortgage insurance remains for the life of the loan. The only way to eliminate your mortgage insurance is through refinancing. So guys, there you have it, a comprehensive look at how much home you can afford with a $50,000 salary under various interest rate scenarios. Guys, if you found this video informative and useful, please hit that like and subscribe button. Appreciate you watching. See you on the next one.